Hello and welcome to the Predictable B2B Success podcast brought to you by Sproutworth.com. I'm Vinay Koshy and our guest is Randy Wootton. And Randy, you are the CEO of Maxio, which is a billing and financial operations platform. And that's very interesting given the bit of research that I did. B2B companies lose 79% of their top line revenue due to inaccurate billing and invoicing processes. Many CFOs still rely on spreadsheets for revenue recognition and reporting, leading to delays in financial insights and decision making as well. And without automated systems, many companies often take 6 to 10 business days to close their books, delaying critical financial analysis. Private equity firms consistently identify pricing as a top concern when acquiring B2B SaaS companies, indicating a widespread issue in this area. And a couple of other interesting facts. Many B2B companies focus heavily on customer acquisition and retention, but often overlook potential strategic monetization. And finally, accounting problems are reported as the number one deal killer in fundraising or exits for B2B SaaS companies as well. A very interesting space, and I'd be keen to get your thoughts on how B2B companies can leverage monetization strategies to drive revenue growth as well as maximize their evaluation. But Randy, you actually got 25 plus years working in the tech space. You were the CEO of, I think it was a Percolate as well as Rocket Fuel,
Yep.
which
Yep.
you scaled to 3+ figures in year-over-year growth before you sold them. You joined Maxio, which in 2021, if I've got my facts right, was the result of a merger between SaaS Optics and Chargify. But I'm curious, why proceed to take on the leadership role at Maxio?
Yeah. But Vinay, first, you nailed it in terms of what we're trying to do and the problems we're trying to address. Let me know if you ever want a sales job because I think you got it. And Maxio, as a company, what we're helping to solve is that order to cash or order to insights challenge. As you said, billing, reporting, RevRec reporting. We also do collection and payments. We sit between the CRM and the general ledger. And so we primarily serve B2B subscription business. Within that, it's B2B SaaS. And so if you have a subscription model where you take the contract, you get paid for the cash, but you need to recognize the revenue, deferred revenue. It can get really complicated. And so that's part of what we're doing is we're helping with the invoicing and the billing. We're helping with the collections to address what you mentioned in terms of the revenue leakage. And we're facilitating faster insights. So to your point, part of the reason I came to Maxio was I was a customer in my last company called Percolate. And in that role, I remember the CFO came to me and said, "Hey, we need to buy this new technology." He's like, "No, we can't. We're spending too much money on internal software." Classic CFO, he bought it anyways and then told me we had it and we started using it. And it changed our lives. It changed our lives in terms of the way we thought about closing the business each month, understanding what was happening broadly across our customer base, because it helps inform the operating metrics that you need to run a SaaS company. If you have the billing and invoicing data, then you can start to do the gross retention, the net retention by customer cohorts. You can do the MRR roll forward. And any of your listeners who have tried to raise money with VC or PE know that those types of reports are the reports that people care about. They want to understand the business, what's working, what's not in terms of attracting customers, retaining them, and growing them. So it changed my life. And yes, to your point, I'd been in MarTech and AdTech for 20 something years. I'd had 2 exits. I don't have a helicopter or a yacht, so I'm still working for the man, but they were nice exits to get done. I took a little time off, and then a recruiter called me about battery. And because I had some familiarity with SaaS Optics, I was like, oh, that's really interesting. The other piece that was compelling to me was the Chargify legacy Chargify capabilities, which are really in usage-based pricing and subscriptions. And so in the model today, you have fixed rate term subscriptions, often done through sales-led motions, and then PLG, which is all the rage, is often, not all the time, but often a usage-based model. And so bringing those two capabilities together, the more simple SLG model, fixed rate, with this very complicated usage-based billing and being able to say, hey, you build it, we bill it type framing was really exciting. Number 2 was, I just think in everybody's journey, if you're operating at the edge of your own ignorance, I'd done MarTech and AdTech for a long time, and I wanted to see if the patterns that I had learned through lots of failures, war wounds, would apply in a different industry. And so going into the office of the CFO, I thought would be an interesting challenge. It certainly has proven to be that. in terms of how do you sell to CFOs, how do you get them to care, how do you get them to let go of their Excel models. It's like the NRA; they don't. You can pry my Excel model from my cold dead hands when I'm on the other side. But yeah, so that's a little bit about Maxio, a little bit of my journey today, and super excited. Been here about 2.5 years. We've made some good progress in launching a new brand. We're putting out some cool thought leadership. Your audience, we can maybe in the show notes add in a link to the Maxio Institute Growth Report, where we take the data from our 2,000 customers, aggregate it up, and have provided each quarter over the last 8 quarters growth trends by revenue size, by industry, and by pricing model. And we hope that's something that people would see as helpful to them in their own planning, perhaps as they're going into their fiscal year 25 planning, and helps contextualize how their growth is compared to other private markets.
Now, to give listeners a bit of an idea of the size of Maxio, your platform currently supports well over 2,400 customers.
Yeah, it's in the 2,000 plus range. We're probably, I should know the numbers exactly, but call it like 85% US or North America, Canada, 10% EMEA, primarily UKI, and then 5% in APAC, primarily Australia and New Zealand. So we do support global companies. We have a global workforce in all around. And our sweet spot would be companies that are about $1 million in ARR up to about 70 million. We do have a couple hundred that are greater than 100 million using us. We have 50 public companies that use us, but they use us within a division that's experimenting with like usage-based pricing. And then we do support pre-rev. The big challenge for us, and one of the things we're working on as a company, is to build our own PLG model. What you find when you deploy a software like ours, it takes an implementation. And so we're trying to simplify it. The challenge is a lot of companies have complex financial operations, how they want to do things, and you just can't get live in 5 like you can with Google search. It's a complex set of workflows, jobs to be done that we're trying to instantiate in the platform. But we're trying to simplify that, make it easier for even the smaller companies to be able to sign up for Maxio.
And you do something like 13 billion plus in both invoice. 17
17
now.
billion. So we have $17 billion flowing across the platform. We've helped companies raise more than $100 billion in funding.
Wow.
So they use the data, early stage companies, as they go through the different stages we used to, one of our, back when everyone was growing, one of the taglines was get funded, stay funded. We've had companies be able to raise Series A, Series B with no finance people. So once you have this power of the data, and I know it because I actually, longer story longer, is I sold Percolate to Seismic, which was a large sales enablement system company. I stayed on for 2 years as chief strategy officer. As part of that, was responsible for M&A. And we looked at a bunch of deals. We did 3, deployed about $300 million in capital. And of the 2, one was a SaaS Optics customer and the other one wasn't. And it took us 10x more time and dollars in forensic accounting to ascertain what was going on in the company that didn't have SaaS Optics. And they were about 1/10 the size of the other company. And so I know from both sides, selling a company at Percolate, we had all of our data in SaaS Optics. It made the cycle, the due diligence cycle, go really and easily. And then on the buyer side, similarly, it made our jobs a lot easier and a lot less expensive in terms of time and dollars and due diligence. And that is another thing, consideration for people as they're thinking about this type of technology is, what is your ultimate goal? If you're running a lifestyle business, you don't need us. But if you're trying to grow, you're trying to add customers, you're layering in complexity, you're ultimately looking for funding in some sort of transaction, you need something like what we can do.
Right, brilliant. You've obviously been a tech leader for quite some time. I'm curious, when did you first realize that you were a leader?
Oh wow, that's an interesting question. What I would say is, I actually, if you back up in my career, I have 3 phases to my career. One was in the military, one was working my way up the corporate ladder, and the third is this executive role, probably for the last 9 years. But I was really compelled to try to be a leader. I mean, back in high school, I can remember I wanted to lead the club and I wanted to be the captain of the team. And then I went to the Naval Academy. And one of the ways they describe the military academies in the US is their leadership laboratories. And you go there in part to study leadership. Every year we had a year-long leader class we had to take. You get a lot of experience to practice being a leader at the school. And then when you go into the Navy or Army, Marines, whatever, you end up with very practical small unit leadership skills. So when I was 25 years old, I had a division, I don't know, 100 something people reporting to me. Now I had senior enlisted, which are like your managers, directors, keeping me from doing dumb stuff. But you still had this identity, role, responsibility to be a leader. And so then I went to business school, I went to one of the business schools. It's a general management program because I wanted to see if I could translate those skills from the military into the civilian sector. So I think I've always been compelled to want to be a leader of people. I have certainly learned how to be a good follower, and I really appreciate great
Hmm.
leadership. But when I left the military, I wasn't going to be on track to be admiral, and I think what I aspired to be was be
Right.
CEO. So I knew that was what I wanted to do. I feel very fortunate that I've had the chance to do it 3 times. Clearly, I haven't nailed it. I got a lot more to learn, but it's been I'd call it a leadership
Hmm.
journey, right? I read a lot, I share a lot, and nothing makes me happier than when people that I've worked with come back and say, "Hey, Randy, you've made an impact on my life." And at the end of the day, I think that's what leadership is about: is creating a vision, inspiring people to go after that, and then leaving an impact in terms of where they've been in their career and what they're
Hmm.
choosing to do next.
Brilliant. And given your journey to date, what would you say would be your personal area of strength?
Other than sending emails, as an English major, I can send good emails, and my team will tell you I send too many emails. But I my personal strength is, or at least before I became CEO, I think people would say Randy got things done.
Hmm.
I just had an enormous amount of capacity to grind out work. Now, whether it was the right thing to get done,
Hmm.
I don't know, but I was going to out hustle anybody else, and I think that came in part because I left the military, went through business school, and then had a real inferiority
Hmm.
complex, right? Because I'm showing up to these jobs where other people had been in the civilian sector for a bunch of years, and I know nothing about product management. And now I got to go be a product manager. And so I was just like, I'm going to hustle anyone. And I work incredibly long hours and et cetera. So I think there's this, what you would find people will say my leadership style is a pace
Hmm.
setting leader. So I'm always pushing hard to, hey, how can we get better? How can we get faster? Sometimes that can be intense. So I've been going to therapy for 25
Hmm.
years to work on that. But I think people that would work in an organization that I'm leading at this point would feel like they're challenged. They understand what they need to do. They understand how to make an impact. And they know when they show up at a meeting with me that I'm going to ask hard questions, but I'm going to be supportive and complimentary. And hopefully, what I'm doing is adding top spin and not
Hmm.
blocking people.
I'd appreciate it if you could expand on that a little bit by asking this question. In that area of strength, what is something that businesses don't know but should?
In the area of getting
Hmm.
things done, or in the area, yeah, well, look, I don't have any original ideas. What I would tell you is there are some great thinkers out there that write books about execution. So one of my favorite books is
Hmm.
Execution. I think that's by Bozzity. There's another book out there by John Doerr around OKRs, and I think maybe this comes from my military background. I fundamentally believe you get what you inspect.
Okay.
And so what does that mean? You need to set up a set of metrics. You need to understand what those metrics are and what the targets are, and then you need to set up a system in where you bring
Hmm.
accountability. And this isn't to make people feel bad or throw them under the bus, but what I would say is we all have limited time and resources. And so what you want to try to do is ensure that you are focused on the right things and you have ways to measure, are you making impact, leading and lagging indicators. And so people may accuse me of having too many scorecards and too many metrics. You're probably right, but I think the ongoing discipline of having clear objectives that you're trying to achieve. So an overarching mission, what are you trying to achieve broadly? Breaks down to a set of objectives that are more descriptive of where you're going to go, which then with the OKR construct, a key results. So I always do a plan on the page, which is a 90-day look at the set of things that need to be done. So the activities, and then the scorecard. What are the metrics you're going to use to measure? And then you arm wrestle over the
Hmm.
targets. I think when you're using data-based decisions, you can then do things, I call it mitigating the red. So you're looking at what's red, what's going red, and you're spending your time on the problems. You celebrate the greens when things are green, but you're managing to the exception. You're looking for why is something going wrong. And I think all the great companies have that's why you scale
Hmm.
leaders. Like an early stage company, if you are a charismatic leader, incredibly visionary, genius culture, you may be able to keep that all in your head and you're working across all the different functions and you're like, here's the 6 things you need to do. But as soon as you start to bring in seasoned executives, so call it series B, series C, who are functional experts, they're going to know more about their function than you do. And so then I think that your responsibility as a CEO is to create a container, a rhythm of the business, a container in which that team of functional experts can become the first team, as Patrick Lencioni talks about, and they become business leaders first. And so that means you need your HR leader to care about uptime on your platform. You need your engineering leader to care about the website. And the way you do that is you create this common language around objectives, key results, and
Mm.
metrics. And so then everybody sees that they're being held accountable and they can ask questions about why did this work or what are you thinking about this? And I think that collective, the power of the growth culture where you're bringing people together versus the junior culture is really the insight of long-term success. Even though in America we tend to glorify and laud the genius culture, so the Steve Jobs of the world, the Bill Gates of the world, I think if you look at the preponderance of successful companies, they are the ones led by people who create the growth culture using a system of accountability.
That's a very interesting point you make there. Would you say that the fact that there are still CFOs out there who rely heavily on their spreadsheets for revenue recognition and reporting is because of a lack of that growth culture, or is it just a fixed mindset in certain areas?
I think there's a couple things. The thing about CFOs in particular that I've learned and I appreciate is at the end of the day, it's their butt on the line for the cash. Right? So they have to have it right. It can't be like I was an English major. I'll swag at things and say, I don't know, 80% is right. And if a great CFO will say, no, we've closed the books down to the tenth of a penny. We know what our cash is. So I think there's a piece of control that the CFOs want. That's why if you try to sell CPQ is usually bought by the CRO. It connects into the tech stack of the CFO, but the CFO doesn't trust what Salesforce is saying. They want to be able to control their domain. And I think the most control comes from them having their Excel model that they've built. Every CFO I know goes into their company and they rip out the old model and they build their own because they want to know every single driver, every single assumption. They don't want any hard coded cells. Doing that is a great strength. It's also I think in some ways old
Mhm.
school. That there are technologies now, and as we go into the future where you have AI building models and having more intelligence, you have a black box which is producing answers that a CFO may say, "Look, I don't know where that came from. I can't disaggregate the formula and find it across my 50 tabs because the AI recommendation agent just made that recommendation." I think we're hitting a real kind of inflection point versus from those that need the Excel versus those that can rely on the AI. I think in the dynamic of an executive team, everyone turns to CFO to say, hey, where are we with the
Mhm.
ARR? And hey, where are we with the revenue? And where are we with our EBITDA? And so I don't know if it's a genius growth culture thing, but I think CFOs, to be fair, they also like being the shell answer guy, that they've got the answers. And so if they have a system that opens it up and everyone can look at it and poke at it, then they're not necessarily what they've uh, uh, governance, compliance, accuracy is taken a little bit away from how they've identified themselves for years. So I think maybe to your implied point that the strategic, but I would say what we're finding is the back office CFOs are the best are moving to be strategic partners of the business. And to do that, they need to be more transparent and share the data. And that's where a system like Maxio helps is you have this data coming out of a system, not a
Mhm.
model. And then it's up to the CEO to help frame the strategic questions to be asked or options to be explored.
Thank you for that. There's a couple of questions that come to mind, but for clarity, would I be right in thinking that Maxio bridges the gap between the CRM and the general ledger system?
Exactly. So what we do is the CRM is usually owned by the revenue function, and that's most companies are using either Salesforce or HubSpot in the space that we play, and that's where the orders
Mhm.
get entered, and where the sales team is managing their business. But you got to take that order and you got to bring it into the finance system to be able to identify what was the contract, what was actually agreed to, how do you translate that into an invoice, how do you send those invoices, and then how do you create the journal entries in the general ledger, right? Because that is for gap accounting, the general ledger is the
Mhm.
system of truth. And it's either QuickBooks when you're early stage or zero in Europe, or what you find is companies get to that 50, $70 million tranche, they move to NetSuite or Intact, is that you cannot mess with the general ledger. And that's why so few people have access
Mhm.
to it. I don't even have access to our general ledger. I don't want access to it. I don't ever want to be able to mess with the general ledger, but the controller and the CFO and the appropriate people on the finance team are in there. But it makes, and It's such a big deal. Still takes 8 to 10 days to close the books. And so those folks, 2 weeks of every month is just spent trying to sort out what happened in the general ledger. With Maxio, you can get access to the revenue data sooner and start working the business
Mhm.
problems. But I think CFOs, when they show up at the board meeting and say, here's what our revenue was, and here's what our EBITDA was, and here's our cash, it needs to be right.
So, with what you're describing, would it also be fair to say that there's an element of AI incorporated into the platform, like Maxio, which allows for business intelligence queries to be made in order to look at avenues where you can maximize revenue generation?
Yeah, Vinay, are you sure you weren't at my last strategy review meeting with my board? I would say ideally, yes. And I think that some of the bigger companies, the NetSuites of the world, the Intact of the world, have the funds to invest in data scientists, and they have an enormous corpus of data that they're using to create already AI augmentation to the accounting software. I think what you find, there's some cool next gen
Mhm.
technologies that are out there that are using AI, for example, with FP&A solutions where you have a bunch of data and you're doing scenario planning. We are going down that path. What I would say we have today is the first step is aggregated data that then we manually crank on to come up with the insights. As I think I was mentioning earlier, the Maxio Institute Growth
Okay.
Report. That's a lot of days of
Mhm.
work of a couple of analysts grinding it out. That's in part because of how the data is structured in our database today, how it's accessed, and all the caveats you got to put on. I keep looking at that going, dude, like we need to put an intelligence layer on top of that. Having run a true AI company in the past, which was first
Mhm.
gen AI, logistic regression analysis, predictive analytics, we had 27 models going every single day. I know the power of AI. I think what a lot of people don't appreciate is to get there, you have to have your data structure, your data lake all sorted for you to be able to do that. So it's on our roadmap to be able to do that more automatically. And then next gen would be have AI going against the data to then make recommendations for individual customers in terms of, hey, if you want to optimize for the rule of 40, here's 3 ways you could think about it based on all the data we've seen across all other companies and who's winning and who's losing. Uber point, I think, is you want to be a system of record in some way. If you own the data, you have the opportunity to layer AI either through Gen AI or predictive analytics going forward. And all companies are going to have to embrace it. I would say over the last 2 years, there's been a wave of let's
Mhm.
experiment with AI. But I think in the boardrooms today, what you're hearing is everyone is leaning in and saying, if you don't get on this in the next 2 years, you're going to fall behind because there's going to be a whole set of new companies that are going to be building on top of the models
Yeah.
that are available and coming right after you.
Certainly. That makes a lot of sense. Given your journey to date, and I'm asking this question because I've been told by a number of people who have done serial exits that really with starting a company, you should start with the end in mind. As a CEO
Mm.
coming into a company like Maxio, are you similar? Are you coming in with a similar mindset as to what the end game is for Maxio? And if so, how does that work out in terms of the financial aspects of the company?
Mm.
Because having that, I think, is a linchpin to the end game, so to speak.
Yeah, it's a great question, Vinay. Look, I'm the guy that is asked to come in when things aren't working. And it's usually by shareholders, VCs or PE firms. It isn't working the way they
Mhm.
want it to be working. They've put a bunch of money in and they're looking for an exit at some period of time. And so I think to your point, the end in mind as a CEO, as a professional CEO coming in, is getting aligned with shareholders on what their timing and valuation expectations are based on the amount of money they put in, and they all have commitments to their LPs. The PE firms need to return 3 to 5x, and the VCs at different stages have different. But in some ways, it's super simple. You say, "Oh, okay, that's what we need to do," and then it becomes an arm wrestle over when could we achieve that and what comprises that exit in terms of organic growth from the core set of capabilities, new stuff you're building, and or other acquisitions. And so, one of the reasons I was excited to come to Maxio was because it was already an M&A, and we called it an MOE, merger of equals. They brought two companies together, and you had to drive the integration, and that's what I was going to come help do. And we've been working on that for a little while. In addition, Battery had a thesis around there's an opportunity for either a roll up or a consolidation of capabilities. And so let's go look at a bunch of other companies and see how we make this platform bigger by adding additional capabilities. And I think any company in that, once you've got initial product market fit and you start to look for additional products, additional segments, additional regions, your growth is going to be some combination of organic and inorganic. And so getting aligned with shareholders who believe in that and want to invest in that growth is really important. So yes, when we do our strategy, we just did a strategy conversation with the board in September. Your strategy doesn't change from year to year. You have a 3-year strategy and you articulate what are the growth levers going to be. Then we come back in November and with the CFO, we start to talk about our 3-year financial plan. So you have a 3-year strategy translates into a 3-year financial plan, which is, oh, okay, now if you think you're going to go in these areas, these are the levels of investment you're going to make. This is what the growth you could expect. Here's the EBITDA you would need to generate. And then it becomes a math exercise in how do you allocate it to more engineers versus more growth. So yes, those become the financial targets that we try to drive through. And then the next step is you take that expense envelope and you roll out to the team, the executive team, the overarching goals for the next year in line with the 3-year plan. And that translates and informs the objectives that you're going to build as a team. And then, how many dollars are they going to get? And the software business is mostly people, right? Other than marketing, where you have investments in programs, paid events, all that sort of stuff. It really is how many people you're going to get and how much you're going to pay for them and how much capacity does that give you. And the key is driving that alignment between the product roadmap in terms of the set of capabilities you're going to bring to market, your monetization strategy in terms of how you're going to monetize that stuff. Are you going to stuff some stuff for free? Are you going to charge extra for others? And then having that line up with your go-to-market engine, the salespeople selling new prospects, and then current customers. When you get to become big enough, you've got a bunch of customers and your objective is to go expand those. How do you drive that? And so that leads into that operating plan that you want to try to achieve for the year.
In a lot of companies, I often find that CEOs do not really disclose the end game, so to speak.
Oh,
They
really?
talk more about vision, the impact, and all the rest of it.
Yeah.
To me, having been in some of those companies, it's a bit of a disservice because we're playing a
Mm.
different game to the game that the CEO or the executive team has in mind. How are
Yeah.
you bringing about alignment to the key objectives that you've been?
Yeah. It's a good point. I don't look. What I'm not sharing with the broader company is the valuation expectations of battery and how much money they're going to make. What I do share is this idea. We call it Max One. We want to be $100 million company. We're not there yet. We've got a ways to go. But I think of $100 million in software as being one of these really interesting inflection points. And we can talk about there's 0 to 1, you're just trying to proof of concept. 1 to 10 is you're getting product market fit. And then I do think you enter this funky zone, I don't know, 10 to $50 million. I call it the valley of death, where you got to be able to hire people and on the sales side, start to build a customer success organization, build out scaled engineering. You're going to be rolling out multiple products. Your CAC is going up. So it's this really hard time to scale and grow. And then call it, I don't know, 50, 70 million to 100 million is that next point of where if you get all that going, you start to get the flywheel, you start to get growing again, and then you get to 100 million. Why is 100 million relevant? 100 million, if you're EBITDA positive, is now you become relevant to a lot of the big companies that might want to buy you. And I know this from personal experience. I tried to sell 2 companies to Adobe, one of which was subscale and not profitable. And they're like, look, we love what you're doing, but you're too small. You're not going to make an impact on our revenue. And in fact, because you're not profitable, you're going to drag down our earnings, and we cannot have that. And so there was this in my head is you have this mark of if you're going to do a transaction, if you are in most companies, I think it's 85% of all software companies get bought, they don't go public. And the goalpost for going public has changed. It's like 400 million now. So, you get to $100 million. I think you start to have different conversations. I think the other thing about $100 million as a threshold is if you're $100 million, you are big and you're operating at scale and you're probably one of the leaders in a category, especially a new category where you got a bunch of competitors out banging around. Very few companies make it to 100 mil. So I think there's this overarching goal for the organization that you can establish with revenue targets and what's our 100 million at what is our EBITDA, because those two things, efficient growth, come together, right? Growth, top line growth, and EBITDA margin come together to say you're a working company at scale, cranking off cash, and you can do a lot with it. So I think that is so you start there with 100 million bucks, and then your fiscal year plans as a private company, you can be much more transparent in terms of what the goals are for this year. I don't know if you've worked at public companies, but when I was a public company CEO, you can't share
Mm.
squat with the team that's not going out on through the earnings call and with the street. And because you're trying to manage that so tightly, you really cut down on the information that you can share around financial performance with the broader team. And so there may be a little bit of obscuration happening in that context. But I think if you're a private company, defaulting to
Mm-hmm.
transparency and then disaggregating the Uber goal of $100 million into those other components that we were talking about, all those different pieces in terms of booking new logos, cross-selling to customers, driving new pricing, attaching products to specific attach rates. That's how you make it real for them to understand how they're impacting the
Mm.
business in line with that broader
Thank you
mission.
for that. When it comes to making money, especially with B2B SaaS companies, for example,
Yeah.
there's the acquire, retain, and monetize.
Yeah.
Would that okay? You've agreed that those are the key three aspects to it. How would you approach it by having this financial data in order to drive those
Yeah.
three key areas?
Yeah, and Vinay, I would say what's interesting to me is I always have thought about how do you acquire, retain, or
Hmm.
secure and expand customers. The monetization one is one that I got very clear on at Maxio, which I'll
Hmm.
talk about in just a second. But I think the acquisition model, because if you use a system like Maxio, you start to get all this data that helps you understand your gross retention and net retention. But at the next level, you can start to look in at things like your customer acquisition costs. So you start to really understand, like you put a
Hmm.
dollar in, and today it's almost you got to put $1.30 in to get a dollar. So meaning you got to have your customers stay with you longer than a year for you even to recover that initial investment. But using this data to understand how your go-to-market engine is working is wicked important on the acquire side. And similarly on the expansion side, I grew up in customer success at the time before I went to Salesforce. I think where I was previously, customer success was thought of as a cost center. But Maria Martinez, who ran customer success at Salesforce, really championed this new way of thinking about customer success could be a profit center. And so now you start to think about how do you invest in customer success so that you can extend the lifetime value of those customers. And she changed the entire industry. So I think there's a very disciplined approach that you can apply to increasing your
Hmm.
time to value for your customers, ensuring they're getting adopted, and driving retention and expansion through your customer base. The piece I didn't fully appreciate, you always think about pricing and packaging, but for the most part in SaaS is done pricing on a per seat base or
Hmm.
per user base. And the way that you drive more growth is division hopping. So more people within one division and then jump over to the new division, or you add in more features, but it's like a percent on top of the seat charge. The business model of Maxio, like other companies in this specific category, are sold primarily on your trailing 12 months of revenue. And the assumption is as you get bigger, we're providing more value, we have different modules, et cetera. So pricing as a lever was something I didn't fully appreciate in terms of were we pricing at market, were we behind market. And what we did is we went through one pricing exercise. Oh, period, new paragraph. I would say PE firms really appreciate that pricing is a major lever. So monetization, right?
Hmm.
What is the offer? How do you price and package it? How do you track the impact of that through cohorts? How do you see the being reflected in terms of attach rates and then
Hmm.
retention rates? So that whole discipline around monetization, I hadn't had that background experience. So we went through my first year. We did a couple of initiatives. I would say it was okay. We didn't get it right. And then this last year, the last 6 months, we put an enormous amount of energy against it. And it led to us, for example, breaking our current customers into 8 cohorts. And each one of the cohorts had a different dynamic, and there was something we could do to create more value and then capture more value. And so we put those implementations in place, and it's starting to pay off. And I think what you've seen more broadly with B2B SaaS, the industry, even 19, 18 months ago, was there's a bit of a recession and contraction. And what are the two levers that operators pull when they need to increase revenue and reduce costs? They increase price and they cut heads. And that's where we saw the great shaving of heads. 1 million people were cut from the SaaS industry, right? And everybody in SaaS followed Salesforce's increased prices by 9%. Those are the two bluntest levers you can pull. And I think the objective with monetization is to be surgical, is to understand where is there value that you're not capturing, that when you go to your customer and you say, hey, look, well, this is where it is. And you got to do a lot of work in terms of competitive pricing and really spend the time. So that for me, I think is one of the most interesting opportunities that I've learned over the last 2.5 years, and I will apply in any company I'm part with going forward.
Obviously, your experience as a customer of SaaS Optics has influenced your perspective of as CEO of Maxio. Monetization being a key part of that. Was there anything else that you feel has fueled your perspective being a customer of SaaS Optics?
It's a good question. All I would say is just going back a step is how it changed my life was you got to wait till the finance team closes the book. So that's the first 8 to 10 days. And then what often happens is the next 10 days, so the last 2 weeks of the business, the finance team is going through their Excel file to figure out what happened in terms of gross retention, net retention, and all those other metrics. So they've completed the gap reporting that they need to do. They produce the three financial statements. You may be still tracking down some balance sheet items, but you've got that sorted. So now then you turn your energy to operating the business. What would often happen is because it was in Excel and it was super complicated, is we would end up coming into the board meeting 30 days after the month closed with our hair on fire, hoping it was right. And so I always felt like it was just in time delivery of insights. And sometimes we would end up, someone had fat fingered us one of the cells in the 40 tab spreadsheet that we had, the numbers would be wrong. And so you don't ever want to show up to a board meeting where you have VCs, PE, Excel jocks there and say, oh, yeah, our gross retention is 87.2%. And they say, but wait a second, last quarter you said it was 86.4%. What happened? I guess that's okay if it goes up. But if you came in and said 88.3% last quarter and now Q2, now you're coming back and telling Q2 is actually was 87.4, you end up in what I call math camp. And that is the worst thing in the world is to be in the middle of a board meeting, having your CFO having to open up the spreadsheet. And then, yeah, the Excel jock is saying, this is what you missed. How that changes when you have a system like Maxio is you do have your revenue reporting on business day one. So I can work with my head of customer success. I can work with my head of my RevOps person and COO and salesperson while the CFO is closing their books for us to dig in and see what happened. What was our gross retention? And it doesn't change, right? It's a system of records. So it doesn't change. Or I'll give you one example where it does change. Usage-based pricing is really complicated. Figuring out how to do usage-based accruals and how to report on it, it's the Wild West. So 3 different ways you could do it. One, you could do the trailing 12 months and aggregate it. One, you could take this month and multiply 12. Or one, what's becoming more consistent is trailing 3 months and multiply by 4. 3 different ways to calculate your usage. You got to get aligned with the board of what that is. You got to define it in a metrics policy, and then you got to be consistent in the production. I think we were doing trailing 12 months, and we got into the board meeting, and it wasn't accurately reflecting what we thought was really going on with the business. So we wanted to propose trailing 3 months, and they were like, "Oh, okay." We did it, but then you had to go back and recast everything. But it was deliberate and intentional, and we could show breadcrumbs to where the changes were and show how it played out. So going forward, we're using trailing 3 months. We actually have both now that we're tracking because you get different information from trailing 12 versus trailing 3. But it was an example of where you layer in something, you change it, but it's deliberate and intentional because it's reflective of what's happening in the business versus, oh my God, we miscalculated something
Yeah.
and we got to go back and caveat it and mea culpa.
Would you say that there are certain challenges that companies would face when transitioning from spreadsheets to an automated financial system like Maxio?
Yeah, it's a great question, Vinay. And that's what we find is we can get a customer up and running in weeks in terms of starting to do invoicing. If they want the rev rec and the reporting, we call that data migration, and that can take
Okay.
months. And it's usually because they're coming out of a system where the data hasn't been structured correctly and they're operating out of spreadsheets. Literally, I was talking to a guy the other day who said he was spending 60 hours a month to reconcile his ARR
Wow.
because of all the spreadsheets he had to work on. 60 hours. So if you try to automate that, imagine the level of complexity of bringing all that data over and have it structured appropriately so you can use it. So yes, it is an investment if you want to do it. But if you take that 60 hours a month and multiply it by 12, what is that? 7,000 hours a year that you're going to save because of the investment. The offset in the implementation seems minor compared. So I think that short term versus long term payoff is something that everybody wrestles with because this is the way we've done it. It's easy to do it. I do think what you find is, I remember being at Percolate before we had S Optics, and we had this massive Excel file. It was so big that if you changed something, right, you changed input, you had to wait. It was like 3 to 4 seconds for it to process through the whole model, like through all the different tabs. So you'd change one thing and you'd just be waiting for it to happen. And that is mind boggling, mind numbing, and poke me in the eye, frustrating if you're trying to do things, figure out what's going on with the business. It's like sitting around when they used to put cards in computers and waiting for it to process. Excel's wonderful, but it's not built for that level of complexity. And that's where a system like Maxio can help.
Certainly. And now Maxio, I believe, has a billing-based pricing model. Would that be correct?
Yeah, but that was the trailing 12 months. You sell different tiers depending on what your price point is. Obviously, if you spend more, you're going to pay more, but the cost, overall cost or bips of your business goes down. So, yeah, that's the primary cost. With payments, it's cost plus because we do a pass through of Adyen, who's our preferred partner at this point. And then modules, if you're going to do a connection between Salesforce, is a nominal cost for the
Would
integration.
you say that it offers advantages over traditional SaaS pricing? If so, how?
I would say there are people that we talk to who say you should charge based on cost to deliver
Mhm.
invoices. And so if I have 100 invoices, I want to pay $1 an invoice. And what we say is in SaaS, it's not tied, it's not like a machine shop where you're producing something and there's a certain cost in doing a cost plus model. What we sell on is the value you're getting to prevent things like to always have your invoices be correct, to prevent things like revenue leakage, to reduce the time that people are spending on these workflows. So because we use the trailing 12 month as a percentage, sometimes that leads to consternation. I would say it's standard in the industry. Stripe does it for payments and billing. Chargebee, a competitor, does it similarly. Most of the companies, I think, in that office of the CFO, because it's hard. If we're selling to the office of the CFO, the other way on, if you're selling it based on seats, like we have 6 people in finance, 4 of whom are probably in Maxio. The cost you'd have to charge is $20,000 for the system for a mid-sized company, right? That's $7,000 a seat. Like I think people's head would go boom. So I think it more aligns with the value that we're delivering, which is insights to run your business, to raise money, etc. It's probably not as the holy grail is when you're doing a usage-based model where the customer says, "Gosh, every time I send a widget, I want to. I'm willing to pay more because I see the value." So getting that total value alignment is the holy grail. I think we're seeing that play out with some of the AI companies today, and they're trying to figure out how if they're real AI, infrastructure AI, they're incurring a lot of costs to run those
Yeah.
models, and then you have all these queries and prompts. Do you charge on prompt? Do you charge? I was just looking at Agent AI, which is at I think it's produced by HubSpot, and they have an AI model marketplace. And you can go in and you can try the different models, and each time you try a model, you use a credit, and you get I
Yeah.
don't know 30 credits when you start, and then you do a credit burn down. You got to buy more credits, and so that's interesting. So there's a get you hooked on the model, and then you pay like a utility. But they got to figure out how much to charge for each
Yeah.
of those credits. So they've put in a construct which allows them flexibility to change prices. Or if you look at OpenAI, they just came out with a new pricing structure where they charge based on 2 different tokens. And so I think we're seeing this really interesting experimentation in terms of how do you drive towards more value-based pricing and consumption.
Certainly. Appreciate that. Given the merger of SaaS Optics and Chargify, how would you say that it's affected the overall, your approach to brand awareness and market positioning?
Oh, great question, Vinay. I'll tell you, this is from a guy who's worked with a bunch of marketers. This is the question because every marketer wants to launch a new brand. And be careful what you wish for, is what I would say. So, a little bit of background. So, I was at Rocket Fuel and Percolate and then Seismic. None of those companies had anything to do with rockets, making coffee, or earthquakes. And I remember going to a recruiting event when I was CEO of Rocket Fuel, and we had chemical engineers coming up to us and saying, "Oh gosh, there's a company called Rocket Fuel. I want to work here." We're like, "But we have nothing to do with rockets and nothing to do with rocket fuel." So the trend in SaaS naming, because there aren't available names, has come up with these cute names like Maxio. But it does a real disservice, I think, sometimes because it's hard. It doesn't capture what the company does. In fact, when I came to Maxio, the name wasn't launched, and thought I was joining a company where we might have rather than a branded house, we'd have a house of brands. We would have SaaS Optics and Chargify, which very clearly articulate what they do. Right, SaaS Optics is SaaS operating metrics. Chargify is charging. Makes a lot of sense. But they had, over the year that from the acquisition to when I showed up, they had wanted to come out with a new brand, and so I showed up, and almost simultaneously with the brand launch of Maxio, I was like, oh, I'm going to be at another one of these companies where we have to reinvent or start from scratch building a brand. And it's really expensive to manage not just two brands, but three brands. And so the learning for me was we underappreciated the brand equity that was associated with both SaaS Options and Chargify, which had been great companies with 12 years of building brand equity. People knew those
Mm.
companies, and we came out with the classic, hey, SaaS Optics and Chargify becoming Maxio, and then SaaS Optics Maxio, the former SaaS Optics and Chargify, and then the final one is you come out with Maxio. And we went too quick
Okay.
to get to just Maxio. In fact, we brought back the other brands so that at SaaStr just a couple of weeks ago at our booth, we added in the SaaS Optics and Chargify brands at the top of the booth. So the primary brand was
Mm.
Maxio, but we wanted people as they walk by the booth, they would see, oh, Chargify, tell me more. And we've had a lot of people still, when I talked about Maxio and I'll say, oh, it used to be SaaS Optics or Chargify, and people say, oh, I know that brand.
Yeah.
So that, I think, for CMOs who may be listening, like, be really careful in terms of thinking about launching a new brand and then deliberate about the transition from old brands to new brands. It's going to take longer than you expect, unless you have a crap
Mm.
load of money, but it's going to take longer than you expect because think about people's buying cycles. They're buying technology every 3 to 4 years. So it's going to take you 4 years of communicating what Maxio is compared to SaaS Options and Chargify to catch all the customers who might be cycling through billing decisions or rev rec
Mm.
decisions.
Certainly. We're close to wrapping up, but I wanted to get your take on a philosophy that you place a lot of stock in, which is get funded, stay funded.
Ah, yeah. What I would say is that's the goal
Hmm.
of every CEO, right? Is unless you're bootstrapping it, is you're looking for money. And so you end up in this dynamic of where you try to get the very best investors you can at the best price you can, valuation, and keep as much control as you can. What happened was when the VCs pulled back in 21 or 22, started to pull back, and there's all this data that shows like VC number of deals is still down significantly. In our Maxio growth report, we have that data. The assumption was that you were going to spend 18 months raising money, right? You get 12 months of operating, and then you go to the next 6 months to go raise the next round. So you knock that on from a C to a Series A, Series B, Series C. They also had this old assumption that you're going to what they call T2, D3. You're going to triple your revenue 2 years in a row. You're going to double it the next 3 years. And that was the hockey stick that everybody wanted every SaaS company
Mm.
to be on. When the money dried up, basically the VCs turned to their operators and said, you know, that 18 month now needs to be 36 months. And it changed the whole dynamic for how you run a company. Is all of a sudden you growth at all costs. Now it's efficient growth. You got to get profitable. If you get profitable, that means you're not investing as much in growth and other things. And it just changed the whole dynamic. So I still think the mandate to get funded, stay funded is the same. I would say the parameters around who's going to get invested in is going to be very different, and you really have to have good metrics, and the metrics are not just about bookings. It's about showing that you can create a reputable sales engine,
Mm.
so customer acquisition costs, and that you are getting to EBITDA positive, that you have a clear pathway to profitability. There's a great guy out there, one of my favorite thinkers, a guy named Todd Gardner, who wrote this essay which really made an impact on me, called the Dolphin Strategy. And the Dolphin Strategy is you get profitable, and then you've shown you've been able to get profitable. You can go back. So you popped up out of the ocean. You can go back and be unprofitable, but you do that for a period of time because you're investing in opening a new market, opening a new product, opening a new segment, and so you got to do investment. But then you come back up and you get
Mm.
profitable again. And it was one of the first things I focused on when coming to Maxio was to get profitable, because I think you control your own fate when you're
Mm.
profitable. And otherwise, you're at the like I just mentioned, if you're running an unprofitable company and you need money, they're going to jam on you in the valuation if they got you in the
Mm.
negotiation. So I think it's a understanding your capital structure, your capital needs, and what the profile of your business profile of your company is and how that's going to play out in the capital markets when you need capital is one of the critical responsibilities of the CEO in partnership with the CFO and the current investors. And I think any CEO starting a new gig needs to be super clear about those expectations, how much money's in the bank, what's the burn profile if it's still burning, what's the path to profitability if you needed to do it, and then when and how you're going to raise more capital, because you want to do it on everybody's classic negotiating, but you want to do it on your terms. You don't want to have to sell or have to get investment on somebody else's terms.
There's a lot of insights in what you've been sharing, but with this idea of leveraging monetization strategies, do you find that there are perhaps a couple of aspects that often get glossed over or doesn't get much airtime? If so, what would they be?
I would say what gets glossed over is the packaging and the pricing. Is that people just think, like, we'll just match the competitors, and they don't do the hard work to interview customers in terms of
Hmm.
value, perception, trade offs, and willingness to pay. And it requires investment in time and a certain capability that you may not have in house. I think there great companies out there that can participate and help you think through it. Is one that we worked with. There's another guy, Stefan. If people want his name, shoot, I'm totally flaking on it, but he's brilliant. We brought him on board as well. And you need to build pricing as a muscle
Mm.
internally. Like, I don't think you can just rely on consultants, but I think if you've never done it before, if you've never done a serious look at pricing and packaging as a strategy, that would be the thing that's glossed over. I remember I was at Salesforce, and at that, I was fortunate. I was running customer success products and how to productize. And we hired a pricing consultant to come in. And that was the first time that I really had been able to afforded the opportunity to do a real pricing exercise. And it was really interesting. So I think often a CFO will oversee that, but I think overall monetization strategy has to be a CEO responsibility, because it's a combination of product, price, package. You're crossing R&D product, you're crossing marketing, and you're crossing CFO, like the business
Hmm.
model. So that may be the number one.
Okay, brilliant. And to wrap up, if you were listening to this episode, what would you say would be your top takeaway?
Top takeaway, I guess maybe what I was just articulating. If you're, a lot of people think about product strategy, people think about business strategy. If you haven't thought about your monetization strategy, that's the number one thing that you should expand into and explore with your executive team and your investors. It is a muscle that you want to build, especially as you hit growth stage, Series B, Series C.
Brilliant. And if listeners are curious, want to find out more or connect with you, where would you recommend they head to?
Easiest is on LinkedIn. I'm posting a bunch of stuff. I've got a podcast, Vinay, like you, and all the cool
Hmm.
kids have podcasts. So we're publishing episodes there. I'm happy to chat with anybody if they wanted to send me a note at randy.wootton. It's WOOTTON. So two O's, two T's, ON at maxio.com. I always have 15 minutes to chat about something. I hope it's more than just call me to sell me something. But if you got a question around monetization, I've been writing about the 7 secrets of success for CEOs. I don't have all the answers, but I've done it now C-suite for 9 years, and I think I've got some ideas. I'm happy to talk to early stage founders and CEOs about how they think broadly across those 7 dimensions. So always happy to have a conversation. I don't really do Twitter. When
Hmm.
it moved to X, I dropped off, and so it's LinkedIn or
Okay,
email.
brilliant. We'll include links to that in the show notes. Randy, thank you so much for doing this. It's been an absolute blast.
It's been a lot of fun. Great questions. You made me think. Thanks, Renee. Have a
No
great day.
worries.